Feroze Azeez, the joint CEO at Anand Rathi Wealth, joins in now. Feroze, looking at the kind of recovery that the market is seeing today, market is getting into the mood swing mode. Basis the escalation or de-escalation talks on war in Middle East. Now, how do you see the confirmation of this kind of a recovery and the path ahead in the short term?
Good afternoon, Nisha. I think, like I've always been saying, markets are going to be buoyant. Markets are, of course, in high octane news dependency. That's what happens when stuff like this happens, when there's a war. Of course, news is going to drive it. War, will it get over? The answer is yes. How long? We don't know. Right? So will the markets go back to 2005, 25,179, where it started falling from that weekend? It will. That's my judgment. Okay, over the last 12 wars, markets always, after the war finishes, have gone up 7-8% more than the level from where they started falling. This is a very, very reassuring data. War khatam hogi, wo to nishchit hai. Kab khatam hogi, pata nahi. But whenever it has happened, then the war is over, markets go back to that level or even more. There's only one instance where after the war was over, the market was still -7 from the where it started falling. So I'm reinforced that the market stability is there, one. When valuations are not so elevated, markets can't fall like a knife. That's very clear and data says so. So if the markets were to again refall 5, 7, 8%, I won't be surprised. But it'll recover very, very passionately in a very ferocious manner. So if you're a long-term investor, if you don't buy this dip, then I don't think you should be in equity ever. Because markets can fall next 5 days, 10 days, 15 days. This is 3 years. There is just one fund out of the total diversified equity funds, which is negative after 3 years. Only one fund. The rest of them are all positive. Even after at the worst part, which is the last NAV, 3 financial years. If someone were to hold it, he has still not lost money. There's only one fund which has lost money. There might be several stocks which have lost money on a 3-year holding, but diversified portfolio does it.
That's right, Feroze. And in fact, one of the key factors that the market is really taking cue from is the crude oil prices. So Brent crude, because of de-escalation talks, has come closer to $100 per barrel from the elevated levels of 116 and 17 that it had touched a few days back. How do you see the crude oil movement and that really putting pressure not just on the market, but of course it has the economic factor attached to it, where our import bill rises and a lot of our macro data gets impacted. So it's not just sentimental, but it also has a material impact on the companies as well as the macros. How does one analyze that bit?
Yes, I think whenever you look at a very high beta variable or a high standard deviation variable like crude oil, it's generally had very large standard deviations because it is a variable which gets impacted immediately during a war, especially in the Gulf region. So whenever you look at a variable like that, you have to see what is the peak it made. If it made 119, 120 as the peak, one is you can see that it went down to 90, came back to 100, went to 110, now cooled off again to 100. But how far are you from the peak is the most important distance you have to measure. Is the peak still ahead of us? I doubt that. If 121 was achieved in a short term, when I think it was 16th, 17th of March, it touched that, and then it has cooled off reasonably. I'm very happy that it's 19% or 18% from the top on the lower side. So if it went up again tomorrow, will the markets again become subdued a few more percent? Yes, it can. But I'm not too worried that it'll establish 150, 170, even 200. I read articles, brokerage firms, when it goes to 120, they start writing 200. When it goes to 70, people start writing 40. They just extrapolate what is happening over the last 1 month. So don't get carried away with recency bias on the crude price. But I'm happy that it's 18% lower than the peak it achieved, which is a very important thing to track.
That's right. In fact, Feroze, defense sector is the one which is gaining the most, and that has been highly volatile. There have been days when it has fallen the most also. While a lot of experts say that defense will not start showing results immediately because there are long tenor orders which will need to be fulfilled, so it's a long haul game. But the sentiment of the war is also impacting defense. How will you play a sector like this?
See, I will play that sector completely bottom up. If I have to play that sector, you have to play it bottom up because each of these stocks are not very highly represented in the top 100. There's hardly any representation of that sector in Nifty 50. Okay, so what kind of free float each stock has? Generally, in times like these, any stocks which have a very low free float in terms of rupee terms or percentage terms, they suddenly shoot up. If three FIIs decide on a specific stock, it can go up 40%. So low free float stocks could be very scary, in my judgment, after the rally, because the rally may not be too many people have not created that rally. 2-3 people can decide and create a stock, create a movement in the stock of 30-40%. So play it bottom up. If you're already buying a stock which has risen, be very clear that you buy a very high free float stock, or just buy the defense index, maybe if you don't want to, or buy a defense mutual fund. HDFC has a fund, you can buy that rather than buying an index as well. So there is some degree of active management needed. You buy it for 3 years, it'll pan out like you rightly said, Nisha. But if you're buying specific stocks, don't buy low free float stock, especially at this stage of the war, where the war could also be cooling off rather than increasing its momentum.
That's right, Feroze. So be defensive when it comes to the defense sector and also be judicious. But which are the sectors which you will say, Feroze, are absolutely, because of the overall market fall, they are also impacted in terms of sentiment, but are now at mouth-watering valuations, and these are the sectors where accumulation can be safely done?
See, when you are in the eye of the storm, I generally recommend diversified strategies because you don't know where you're headed over the next few days, especially when you're buying stocks yourself. If small cap has corrected reasonably and mid caps have corrected reasonably, I would say buying small and mid caps is safer than buying one or two sectors. Like banking was, of course, one of the cheaper sectors, and I liked it. ABC, I used to call it auto banking and consumption. And defense, ABCD, right? But banking had a sudden surprise, as you know. So point I'm trying to get to is when you're trying to make 17-18% from equity markets, your odds are highest when you buy today. But when you buy today, just buy diversification is what my belief is, because sectors could be a lot more riskier. If you want to make 30% compounded for the next 2 years, then you have no choice but to go into stocks and specific sectors. But I think people should not be too greedy at these moments and buy more diversified. But if you really want to put, if I had to put my money in a sector, then definitely it will be private sector banks where they stand today.
Yes, private sector banks, that's what is giving comfort to the market. And yes, banks have taken a hit because of the overall nervousness whenever it crops up because of the war situation. Thank you so much, Feroze Azeez, for chatting with us on your market expertise and your insights. Thank you for joining us.